Bitcoin hit $69,000 in November 2021, and billions of dollars poured into cryptocurrency from institutional investors, hedge funds, and everyday people convinced they were witnessing a financial revolution. Charlie Munger called it rat poison and refused to buy a single Satoshi until his death 2 years later. Here's the thinking framework that kept him out. 2021, cryptocurrency is everywhere. Bitcoin's trading at all-time highs, Ethereum's exploding. NFTs are selling for millions. Every financial news channel is running stories about people making fortunes overnight. Institutional investors who spent years dismissing crypto are suddenly announcing billion-dollar positions. The narrative is intoxicating. This is the future of money. This is digital gold. This is a hedge against inflation. This is the greatest investment opportunity of our generation. Get in now or get left behind. Charlie Munger is 97 years old. He's seen every financial mania of the last 7 decades. The dot-com bubble, the housing crisis, the Japanese asset bubble, the gold rush of the 1970s. Every time it's the same story. This time is different. This time it's real. This time you have to get in. And every time Charlie applies the same framework, the same disciplined thinking process he's used for 60 years, circle of competence, real value, competitive advantages, long-term business performance. He looks at cryptocurrency, he runs it through his mental models, and he arrives at a conclusion that shocks a lot of people. It's rat poison, he says, not just a bad investment, not just overvalued, rat poison, and then he goes further. He compares it to a venereal disease. While the world rushes in, Charlie sits on the sidelines, watching, analyzing, refusing to budge. And here's what most people miss about that moment. Charlie's not being stubborn. He's not being a dinosaur who doesn't understand technology. He's applying a systematic thinking framework that's made him billions of dollars over 6 decades. Today, we're breaking down exactly what that framework is and why it led him to reject crypto completely. I'm Michael, and welcome to The Wisdom Investor. Today, we're diving into one of Charlie Munger's most controversial positions, his complete rejection of cryptocurrency. And I want to be clear about something right from the start. This isn't a video about whether crypto is good or bad. This is a video about how Charlie Munger thought about new asset classes, how he evaluated opportunities, how he decided what belonged in his circle of competence and what didn't. Because here's what fascinated me when I was researching this. Charlie didn't dismiss crypto casually. He didn't just say, "I don't understand it, so I'm out." He had specific, systematic reasons rooted in his investment philosophy. And whether you agree with him or not, understanding his framework is valuable, because it's the same framework he used to build a $2.6 billion fortune. So let's start with what Charlie actually said about cryptocurrency, because the quotes are pretty harsh. Rat poison, that's the famous one, but he didn't stop there. At various Berkshire Hathaway shareholder meetings and in interviews, he went further. He called it worthless artificial gold. He said it was beneath contempt. He compared it to a venereal disease and said he was proud that Berkshire had avoided it. These aren't mild critiques. Charlie's essentially saying crypto is not just a bad investment, it's dangerous, it's something to be avoided entirely. Now, a lot of people heard those quotes and thought, okay, Charlie's just an old guy who doesn't get technology. He doesn't understand blockchain. He doesn't understand digital assets. He's stuck in the past. But here's what I realized after spending months studying Charlie's thinking. His rejection of crypto had nothing to do with not understanding the technology. It had everything to do with applying his core investment principles systematically. So let's break down those principles, because this is where it gets really interesting. First principle, circle of competence. This is maybe Charlie's most important mental model. The idea is simple. You have a circle. Inside that circle is everything you deeply understand. Outside that circle is everything you don't. And the rule is absolutely clear. Only invest inside your circle. Not at the edge, not just outside, inside, where you have deep, comprehensive knowledge of how things work. Charlie's quote on this is crystal clear. We have 3 baskets for investing: yes, no, and too tough to understand. Only invest in what you deeply understand. So when Charlie looks at cryptocurrency, he's asking himself a fundamental question. Do I deeply understand this? Not can I learn about it? Not does it sound interesting? Do I understand it well enough to make a confident investment decision? And here's where a lot of people get confused. They think understanding crypto means understanding blockchain technology, how the distributed ledger works, how mining operates, the cryptographic principles behind it. But that's not what Charlie means by understanding. Charlie's not asking, do I understand the technology? He's asking, do I understand the value creation mechanism? Do I understand what makes this worth money? Do I understand the competitive dynamics? Do I understand how this creates sustainable advantages over time? Let me give you an example of what Charlie does understand. See's Candies. When Berkshire bought See's in 1972, Charlie understood exactly what he was buying: a brand with pricing power, loyal customers who'd pay premium prices for a product they could get cheaper elsewhere, distribution advantages, predictable cash flows, a business model that could compound value over decades. He could articulate specifically why See's would be worth more in 10 years, not because the technology would improve, not because the industry would grow, because the brand would strengthen, the customer relationships would deepen, and the pricing power would expand. That's deep understanding, that's circle of competence. Now apply that to cryptocurrency. How does Bitcoin create value? Well, it's scarce, there's a fixed supply. Okay, but scarcity alone doesn't create value. There are lots of scarce things that are worthless. It's decentralized, it's outside government control. Okay, but how does that translate into sustainable competitive advantage? It's a store of value. But why? What makes it valuable beyond the fact that people believe it's valuable? And this is where Charlie gets stuck, because with every business he's ever invested in, he can point to something real. Coca-Cola has a brand that makes people willing to pay more for sugar water. Costco has a business model that creates value through volume and membership fees. Daily Journal has a software platform that creates value by solving real problems for court systems. But cryptocurrency, the value proposition at its core, is circular. It's valuable because people think it's valuable, and that's not something Charlie's comfortable investing in. Second principle, real earnings and real products. Charlie's investment philosophy is built on a simple idea. Over the long term, your investment returns will roughly match the returns of the underlying business. If a business earns 6% on its capital for 40 years, you'll earn about 6% even if you bought it cheap. If a business earns 18% for 30 years, you'll do great even if you paid a high price. This is a fundamental insight. Your returns come from business performance, not from speculation on what someone else will pay. So Charlie always asks, what does this business earn? What products does it sell? What services does it provide? How does it generate cash flow? And cryptocurrency doesn't fit this framework at all. Bitcoin doesn't earn anything. It doesn't produce anything. It doesn't sell anything. It doesn't generate cash flow. Its value is entirely dependent on what the next person is willing to pay for it. Now, crypto advocates would argue that's fine. They'd say Bitcoin is digital gold. Gold doesn't earn anything either. Gold doesn't produce cash flow, but gold has been valuable for thousands of years. But here's Charlie's response to that, and I'm paraphrasing, but this is the essence of what he said. I don't invest in gold either. I never have, because gold just sits there. It doesn't do anything. It doesn't compound. And I want investments that compound over time through real business performance. Charlie's not saying gold is worthless. He's saying it's not an investment by his definition. It's a speculation on what someone else will pay, and that's not his game. He wants businesses, real businesses with real earnings that can reinvest those earnings to create more value. That's how wealth compounds. That's how you go from good returns to great returns over decades. Cryptocurrency, like gold, doesn't fit that model, so it's outside his circle of competence and outside his investment strategy. Third principle, competitive moats and sustainable advantages. This is another core Munger concept. Don't just buy good businesses, buy businesses with durable competitive advantages, moats that protect them from competition. Things like brand power, network effects, switching costs, regulatory advantages, economies of scale. When Charlie looks at a business, he's asking what stops competitors from eating this company's lunch, what gives this business pricing power, what makes customers stick around. And with cryptocurrency, the moat question becomes really interesting because Bitcoin was first. It has the biggest network, the most hash power, the most recognition. so you could argue it has a network effect moat. But here's Charlie's problem. The barrier to entry for creating a competing cryptocurrency is essentially zero. You can fork Bitcoin, you can create Ethereum, you can launch thousands of altcoins. There's no capital requirement, there's no regulatory moat, there's no brand loyalty in the traditional sense. Yes, Bitcoin has first-mover advantage, but in Charlie's experience, first-mover advantage without other structural moats isn't enough. He's seen too many first movers get overtaken by better competitors. Compare that to Coca-Cola. You could create a competing cola tomorrow, but you'd need billions of dollars in marketing to build brand recognition. You'd need decades to create the emotional associations Coke has. You'd need a distribution network that took a century to build. The moat is massive. Or look at Costco. Charlie served on Costco's board. He understood the moat intimately. The membership model creates switching costs. The volume purchasing creates cost advantages competitors can't match. The treasure hunt shopping experience creates customer loyalty. The business model is incredibly hard to replicate at scale. With crypto, Charlie doesn't see those kinds of moats. He sees a technology that can be copied, a network effect that could shift if a better alternative emerges, a value proposition that depends entirely on collective belief rather than structural advantages. And that makes him uncomfortable, because his whole career has been built on finding businesses with durable, defensible advantages that can survive competitive pressure for decades. Fourth principle, avoiding stupidity over seeking brilliance. This is inversion, one of Charlie's favorite mental models. Instead of asking, how do I get rich? Ask, how do I avoid staying poor? Instead of asking, what's the best investment? Ask, what are the worst mistakes I could make? Charlie's famous quote on this: "It is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid, instead of trying to be very intelligent." So when Charlie looks at cryptocurrency, he's not asking, could this make me rich? He's asking, what could go wrong? What don't I understand? What am I assuming that might not be true? And there are a lot of answers to those questions. Regulatory risk. What happens if governments decide to crack down? Technology risk. What happens if the blockchain gets hacked or someone finds a flaw in the cryptography? Competition risk. What happens if a better cryptocurrency emerges? Volatility risk. What happens if the price crashes 80% and stays down for years? Now, crypto investors would say all investments have risks. That's true, but Charlie's point is different. He's saying the risks in crypto are outside his ability to evaluate. He doesn't know how to handicap regulatory risk in blockchain. He doesn't know how to evaluate technology risk in cryptography. He doesn't know how to predict which cryptocurrency will win if there's a competitive battle. Those are outside his circle of competence. So instead of trying to be brilliant and figure it out, he simply avoids it. He focuses on risks he understands: business risks, competitive risks, management risks, those he knows how to evaluate. This is inversion in action. Don't try to be smart about crypto. Just avoid the stupidity of investing in something you don't understand. Fifth principle, patience and long-term thinking. Charlie's investment partnership from 1962 to 1975 generated 19.8% annual returns. The Dow Jones returned 5% during the same period. That's a massive outperformance, nearly 4 times better. But here's what's interesting about how he did it. He didn't trade frequently. He didn't chase momentum. He didn't jump on trends. He found a few great businesses, bought them at reasonable prices, and sat on his ass. His words, not mine. Investing is where you find a few great companies and then sit on your ass. This is the opposite of how most people approach crypto. Crypto culture is built on momentum, on getting in early, on trading, on timing the market, on speculating on price movements. And Charlie's entire philosophy rejects that approach. He wants businesses he can hold for decades. Businesses that will be more valuable in 10 years, 20 years, 30 years because of compounding business performance. Can you confidently say Bitcoin will be more valuable in 30 years because of underlying business performance? Not because more people might believe in it, not because adoption might increase, but because of real, measurable value creation. Charlie couldn't answer that question with confidence, so he stayed out. Now let me address something important. Some people hear Charlie's crypto skepticism and think he's anti-technology, that he doesn't understand innovation, that he missed the internet, missed Amazon, missed all the tech revolutions. That's not accurate. Charlie's not anti-technology. He's anti-speculation on things he doesn't understand. Did Berkshire miss Amazon? Yes, and Charlie and Warren both admitted that was a mistake, but not because they didn't understand technology, because they didn't recognize Amazon's competitive moat early enough, the network effects, the infrastructure advantages, the customer data, the ecosystem. But here's the difference. Amazon had real earnings, real products, real customers, real competitive advantages. You could analyze it using traditional business frameworks. Revenue growth, margin expansion, return on invested capital, customer acquisition costs, lifetime value. Cryptocurrency doesn't fit those frameworks. It's a different category entirely, and Charlie's response is simple. If it doesn't fit my frameworks, I don't invest in it. I stick to what I understand. And that brings us to maybe the most important lesson in all of this. Charlie Munger is not trying to maximize returns by catching every trend. He's trying to compound wealth sustainably over decades by staying within his circle of competence. That's a subtle but crucial distinction. Maximizing returns means taking more risk, chasing more opportunities, expanding into new areas. Compounding sustainably means being selective, being patient, being disciplined, saying no to almost everything. Charlie's career return speaks for itself. 19.8% annually over his investment partnership. Berkshire's 19.9% annually from 1965 to 2024, over nearly 60 years. That's not from catching every trend. That's from saying no to almost everything and yes to a very few things he understood deeply. So when crypto came along, Charlie applied the same discipline. Circle of competence. No. Real earnings. No. Sustainable moat not clear. Avoid stupidity. Yes, avoid this. Long-term value creation. Can't identify it. Results stay out. Now, does that mean Charlie was right? That's not really the point. Maybe Bitcoin will be worth $1 million someday. Maybe it won't. Maybe crypto will revolutionize finance. Maybe it won't. The point is Charlie made a decision consistent with his framework. A framework that had worked for 60 years, and he stuck to it, even when everyone else was piling in, even when people called him old-fashioned, even when the prices kept going up. That's intellectual consistency, that's discipline, that's what made him successful over 6 decades. Let me share one more thing that really crystallized this for me. In 2023, just months before Charlie died, someone asked him about artificial intelligence. AI was the new hot thing. Everyone was talking about ChatGPT, about how AI would change everything. And Charlie's response was classic. I think old-fashioned intelligence works pretty well. He's not dismissing AI, he's not saying it's not important. He's saying his competitive advantage is in old-fashioned intelligence. Deep thinking, multidisciplinary frameworks, pattern recognition built over decades, that's his circle of competence, so that's where he stays. Same with crypto, his competitive advantage isn't in understanding blockchain technology or digital assets. It's in understanding businesses, competitive dynamics, value creation, long-term compounding. That's his circle, so that's where he invests. And here's what I find beautiful about that. Charlie never felt like he had to have an opinion on everything. He never felt like he had to invest in everything. He was perfectly comfortable saying, I don't know, or that's outside my circle, or I'll pass on that. In a world where everyone feels pressure to have an opinion on every trend, every technology, every investment opportunity, Charlie's willingness to simply say, that's not for me, is refreshing. And it's effective. Because the goal isn't to catch every opportunity. The goal is to avoid major mistakes and compound the opportunities you do understand. So what can we learn from Charlie's approach to crypto? A few things. First, know your circle of competence. Be brutally honest about what you understand deeply versus what you understand superficially. and only invest where you have deep understanding. Second, focus on real value creation. Ask yourself, how does this create value? What are the earnings? What are the products? What are the competitive advantages? If you can't answer those questions clearly, you might be speculating rather than investing. Third, use inversion. Don't just ask what could go right, ask what could go wrong. What are the risks? What don't you understand? What are you assuming? And if those risks are outside your ability to evaluate, maybe that's a sign to stay out. Fourth, be patient. Don't feel pressure to catch every trend or every hot investment. The goal is sustainable compounding over decades, not maximizing short-term returns. And fifth, have the courage to say no, even when everyone else is saying yes, even when prices are going up, even when you feel like you're missing out. If it's outside your circle of competence, the right answer might be to simply pass. Charlie Munger passed on cryptocurrency. He called it rat poison. And whether that was right or wrong, it was consistent with a framework that had worked for 6 decades. That's the lesson, not that crypto is good or bad, but that having a systematic framework and sticking to it, even under pressure, is how you build sustainable success over a lifetime. So here's what I want you to take away from this. Charlie Munger didn't reject cryptocurrency because he was old or stubborn or didn't understand technology. He rejected it because it didn't fit his systematic investment framework, circle of competence, real earnings, sustainable moats, avoiding stupidity, long-term value creation. Crypto failed those tests for him, so he stayed out. And that discipline, that willingness to say no to almost everything and yes only to things he understood deeply, is what made him one of the greatest investors in history. Now I want to hear from you. What's in your circle of competence? What investments have you passed on because they didn't fit your framework, even when everyone else was piling in? Drop a comment below and let's discuss. If you found this valuable, hit that like button and share this episode with someone who's thinking about their own investment philosophy. It really helps us reach more people who can benefit from Charlie's wisdom. We release new Charlie Munger episodes every day on the Wisdom Investor, so subscribe and turn on notifications so you never miss an episode. I'm Michael, this is the Wisdom Investor, and I'll see you in the next one.